operating experience, domain expertise. It can be because of a brand. It can be because of a particular network who didn't get in or who didn't get what they wanted just from talking to the founders. And then you can talk to the other investors in the round if you know them. It's hard. That's a hard one. And I think learning from great investors about how they think about making investments.
Welcome to the Smart Venture Podcast. We're here to bring you the latest and greatest from the Silicon Valley, where unicorns roam and innovation never sleeps. We've got top investors, superstar founders, and well-known tech executives lined up to share their secrets on building and investing in successful companies. Just a quick disclaimer, while we may sound like financial geniuses, but please don't mistake us for your friendly neighborhood financial advisors. So let's get started and dive into the wild world of tech entrepreneurship. Great news for all our Smart Venture Podcast listeners. Since January 8th, I've been hosting a new daily live show, Venture with Grace, on LinkedIn Live at 9 a.m. PT every weekday. Follow me, Grace Gone, on LinkedIn to catch up on past episodes and stay updated with future ones. You will get insights from key industry players and have the chance to ask questions live. Don't forget to subscribe to the show on Apple Podcasts, Spotify, and our YouTube channel under the Live button. Join me on this journey and let's explore the world of innovation and investment together. Hi, Alex. Welcome to Smart Venture Podcast today.
Thanks so much for having me.
Let's start with, you went to school in Michigan. Where do you grow up and how did you become who you are today?
Oh man, I'm from the Detroit suburbs. My path sort of evolved from being a lawyer to working at a startup and then finding my way into the venture world and then, but on the GP side and then eventually moving to the LP side.
Amazing. Okay, so I have a couple questions there. So what does growing up in Detroit look like and how does that shape you into your investing journey today? Were both of your parents like lawyers or you come from the legal world at the beginning? And yeah, just out of curiosity.
Yeah, it's a great question. So my dad is a solo practitioner and a lawyer. My mom is a social worker, but also runs an outpatient mental health practice. So both are entrepreneurial in their own way, not in the venture world or venture backed. But yeah, I think that probably has a lot to do with, where I am today.
Amazing. Okay, so why don't we talk about one of your major career track records at QED? Like, how do you get into QED? You got in as a chief of staff, and how do you kind of evolve into a COO? And what were some core lessons there you've learned at QED?
Yeah, I mean, I was really lucky to get that job as Nigel's chief of staff. So Nigel was one of the two founders of Capital One. He retired, he started QED with some folks who worked for him at Capital One. And yeah, just being close to him was an amazing learning experience. I mean, he's obviously been successful in so many ways, and he was successful as an operator at Capital One. He's successful in venture at QED, and just getting to work closely with someone like him was a great learning experience for me. And yeah, I think about him often. I think about what I've learned from him and how he'd handle certain situations. I think just as I worked closely with him and my role at QED was expanding a bit, I think as maybe naturally came up, maybe it makes sense to give Alex a slightly broader role. He's kind of already doing this. And so it evolved it was pretty organic. And then, yeah, key learnings. I mean, there were a lot of learnings. There were learnings about venture, which, many of which resulted in starting Slipstream and were a part of the hypothesis. There were learnings about just how to succeed as a venture firm, is related, but a slightly different point. And then there were learnings about, just how to manage your relationships and your network and your life and how to prioritize. And so, I mean, I could go into any of those things. I'm not sure how many would be interested, but is there something you had in mind?
Yeah, totally. Okay, so let's start with how to succeed as a venture firm. I'm curious, how does a venture firm business work? From how does the money flow, and what do you think are the key things that the fund manager or the managing partner should have done right for it to be a success?
Yeah. Oh man, that's a great question. And I should be careful whenever I talk about QED or even what I'm looking for at Slipstream. Is there are many ways to win in venture. There isn't just one way. So I saw the QED way, and now I see other firms that have similar traits and resemble, I think, the things that were generating great fund level returns that have generated great fund level returns for QED historically. And there are other ways to do it that have also done really well. So like big caveat, I don't want to act like I have all the answers because I don't. But some of the things that have stood out to me, yeah, and I guess I should distinguish also between like how do you become a good venture investor?
Mm-hmm.
How do you manage a successful venture fund?
Mm-hmm.
And how do you become a great firm like manager of a venture firm, which they're all kind of a little different.
Mm-hmm.
But it sounds like what you're getting is like, how do you generate returns on a venture fund? But tell me if I'm misinterpreting. And yeah, like I said, so no one way. But what stood out to me there, and what stands out to me today is there is some. I guess we can come at this from a few different angles. One is like there has to be. I guess you have to be good at, let's call it, sourcing, picking, winning, portfolio construction, and getting liquidity. I would throw in there adding value, although not all VCs prioritize that. But that was an important part of QEDs. I mean, that's an important part of QED, and that's an important part of what I'm looking for. So I think about it in terms of like a 6-tool VC, like people talk about a 5-tool baseball player. But if I were to like abstract it a bit, it's like, what is the unique, sustainable competitive advantage that like will apply to this team and be a reason they win now and into the future? It usually relates to sourcing, picking, winning, adding value. It often stems from things like operating experience, domain expertise. It can be because of a brand. It can be because of a particular network. And that network could be helpful for sourcing deals. It could be helpful for adding value to companies like customer intros or in some operational way. But it's some unique edge. And so, I think about this in different ways. Like another way I think about it is like, why will this firm be in front of the best founders? Like, how will they even get there? And then why will the founders pick them in a competitive process? And sometimes, there's usually someone else around the table, but the founder still needs to pick you even if there's no one else. And so why will great founders pick this team? That's, sort of all part of that first thing I look for. Let's say there are 5 things I look for. That's number 1. Number 2 would just be like, portfolio construction such that you have enough ownership in a company so that it can generate meaningful fund level returns if it's successful. And the hope is that like a modestly successful outcome for that company can be meaningful to fund level returns. And certainly if it's an enormous winner, then it can have tremendous impact on fund level returns. And then 3 other things that I look for, but this is largely informed by my experience at QED, is like the best investors of the next stage think really highly of this venture firm. They want to see their deals. They trust their views on the market and on founders. They do deals together. They like doing deals together. They're on boards together, or they collaborate together, post-investment. That's really important. The 4th thing is that founders love them and think they're valuable. Like I said, like a lot of folks would say like VCs aren't very valuable, and that's probably true in many cases. But I think the funds that we're investing in, and a fund like QED, I think the founders typically are saying like, no, these are very valuable. These are like our go-to or one of our few most impactful investors. That's really important for building a flywheel, right? So like if you're getting in front of great founders and you're winning allocations in great companies run by great founders, and you make them, like you show how much value you can add, you are a great partner to them, they're going to send their founder friends to you, and you'll generate this flywheel of like sort of positively selected deal flow. And so that's a big part. That was a big learning at QED. It was just like being good to the founders, like being good to everyone, helping them, like managing their expectations and making sure we can deliver on them post investment. So you wouldn't want to like tell them how great it's going to be if we invest and they let us invest. It's like it's not as great as they thought it would be. We have to you have to be clear about what you can do and what you can't do, and meet or exceed those expectations. And then you get this flywheel effect. And the last thing is just like people who are hungry, who are working hard, who they don't have to have a chip on their shoulder, but like sometimes there's like something driving them. This venture's a long game. It takes a long time. It's hard. It's not all up and to the right. And people who have the drive and the hunger and the intensity, I think that's really important to succeeding in terms of managing a successful venture fund and getting great returns on the fund.
I wonder, I have a couple questions there. One is, why don't we start with like, I don't know if you feel comfortable, we could maybe not talk about the names, but can you walk us through like one of like a fund manager that you have invested in, to like basically how you identified them and what you got like attracted to this fund, and like how do you kind of evaluate if they are a good fund? Maybe picking, winning, exiting as an LP. We don't have to talk about like a particular, like I wouldn't have to talk about like that person's name or something. Just like maybe give us like an overall thought process.
Yeah. So how I'm like finding and vetting these folks. Yeah, I'm finding them from established VCs. I'm finding them from QED, of course, or I knew them from QED, or I'm doing a founder reference and a founder's telling me about their few favorite, most helpful funds. And one of them happens to be a fund that I'm not diligencing, and then I get an introduction to them. It could be from other LPs. It could be from our own LPs. It could be cold inbound. I guess, like in my view, like there's no wrong way to meet a great venture firm. And then, yeah, how am I evaluating them? Like I'm sort of looking through. I'm looking for all of those things, and you can tell a lot from a deck. Like, is this the portfolio construction we're looking for? Do they have some unique edge? Some like sustainable competitive advantage. You can get a sense for that from a deck and from an initial call. But then, yeah, it's a lot of like informal referencing with mutual contacts, founders, other VCs, just to try to get a sense for, are these folks serious? Like, are they like great? Are they unique? Are they well positioned here? And then, more calls, data room, founder references, calls with VCs at the next stage in whatever sector these folks are investing. So that's like at a high level, the process. But yeah, could I give a few examples? Yeah, I mean, it's hard to do it anonymously because it's kind of clear from the portfolio, but I will keep it anonymous. Yeah, one that I think is great is someone who has a very long track record of investing, but is still like young, has a very active, like great network, was kind of at the heart of the venture ecosystem over the last 15 years and has tons, I guess almost 30 unicorn investments over the last 15 or so years, and has built both an amazing network, a process for filtering deal flow, an enormous group of founders who think highly of the VC, really refined like picking. They just have a good sense for what they're looking for. They've seen a lot of different success stories in a range of categories over a long period of time, and they're so entrenched in venture that they see a lot and they write checks that are collaborative, and so they can slot into a lot of rounds. The fund is not going to grow. It should be the same size going forward. Like pretty disciplined on portfolio construction, fund size, ownership relative to fund size. And so, yeah, this person is like very uniquely positioned because they have so many people in their corner at this point who are involved in some way or another, they've worked with in some way or another, and that has become their competitive advantage. They're just so uniquely positioned with over 1,000 investments in venture, so many folks who are sending deals and saying good things. It was pretty easy to diligence. It's like, oh, we've done deals with this person at QED. I didn't even know it when I was at QED, but like we had some companies in common. I could just reach out to those founders and like the feedback is just over the top and very consistent. And so you begin to understand like why and how this person has developed a flywheel and like how they have sustained their advantage in venture. That's one example.
I wonder, so let's say we also talk about like, creator turned fund manager before. Like, I wonder what's your overall thought on that? And like, how do people kind of like build a really strong suit? Since like right now, I feel like many people with like some sort of following at any platform is having a fund or angel investing or doing something with venture. I wonder how should they build the picking skill or like the winning skill? Because, well, not winning skill, I guess picking skill is like the majority, since I feel like people they would be having the deal flow because of the media presentation, and like winning it's probably easier because the media presentation, but like I guess like how do they build up like a strong picking skill set in this case?
Yeah, I mean, I first of all, like to the initial question about whether someone with that profile can have a great venture fund or great venture firm, like of course, like that can be an edge and that can get you in front of founders and help you source. That can be an edge that helps you win and add value. And yeah, I mean, one thing that I didn't say, but that I should have said when you asked about like how to build a successful venture firm, and I don't think this is unique to QED. Like some of the things that we've talked about so far, it's like, I want to be careful. It's like, there's not only one way, there are a lot of different ways, but like, I do think it's important for everyone to think about like, what is so unique? What is my edge? What's so special here? Like, why does this firm exist? Like, what's my hypothesis about why this fund's going to succeed? and to build their strategy around that.
Mhm.
So when you talk about, someone who is more public facing, like what are the types of companies that you can help? What are the types of founders you're getting in front of? What types of checks, like what size checks or how much ownership do you think you can get? Like it may not make sense for that person on a fund one with limited investing experience to go out and try to lead round. That might be hard to compete against folks who have more experience and who have a bigger brand and venture and sort of all the things that you would expect. But it might make sense for them to write small participating checks into rounds. And if they can prove to founders that they can add value, then that makes sense. So then the question is like, well, what types of founders?
Mhm.
And so I think it's hard to speak generally about that, but like you would be thinking about what are you uniquely positioned to source? What types of companies are you uniquely positioned to help? And then in terms of like honing in on picking, I mean, it's hard. That's a hard one. And I think
Mhm.
learning from great investors about how they think about making investments and what they've learned and in their investment experience from their investment experience is the best way I can think of. And so if you have no investing experience, then if you're able to, build relationships with folks who have more investing experience, and to learn from them, I think that would be one way to, get a better sense
Mhm.
to develop as a picker.
I wonder when you are, let's say, evaluating their fund performance, like what are some indicators that you would say, oh, I think they are good at like picking or good at like winning?
Yeah, it's a good question. And there are other ways, I should say, like if you want to talk about how to become a
We'll
good
go with
picker,
the
like,
Alex way.
well, I know I'm just responding on the fly here, but like, if you look back at companies that have been successful in whatever sectors you're investing in historically, like what are the founder backgrounds? How did those companies look when they were really early? I think like that can give you a sense. You want to know what success looks like. So, but getting back to your question, yeah. So how would I look at a fund or how would I get a sense for whether someone's good at picking or winning? Yeah, I mean, beginning, you want to get a sense for like, are these companies showing much traction in terms of revenue or growth in other ways? Are these companies attracting capital from great investors at the next stage? I think that's another way. Whether they can win competitive deals. And ultimately, the longer they've been investing, like, the more you can get a sense of like whether the companies they've invested in have become real companies, successful companies, whether they've exited and generated DPI. But in terms of winning, yeah, like I want to understand the round dynamics. I want to understand from the GP, like, how did you source this? How did this happen? Was it competitive? Did you get what you wanted? Could you have gotten more? Did you get cut back? How did you win it? Like, what do you think was the reason that you got an allocation? Was it the lead was, advocating for you? Did you bring your sort of network or other founders that you've worked with and have them reach out? Were you just persuasive in some way, or on some topics? And then you want to talk to the founder and you want to say like, hey founder, like how'd this round come together? How'd you meet that person? Why'd you pick that person? How competitive was this? How much time did they spend getting to know you? Did it seem like they really understood the company? Like, did they challenge you? Did they like what impressed you about them? You want to get a sense like what the dynamic was. And you can get a sense for how competitive it was and who didn't get in or who didn't get what they wanted just from talking to the founders. And then you can talk to the other investors in the round if you know them. So yeah, those are the ways that I'm thinking about how to evaluate a fund or just like an investment track record. In any case, it could just be like a series of angel investments. Does that answer your question?
Totally. I wonder, what do you think that is like some mistakes that emerging managers typically make while they're pitching to you?
I mean, it's a great question. So, I mean, sometimes I'm meeting folks with very little investment experience at this stage where they plan to invest out of this fund. That can be tricky. It's like, oh, I was a growth stage investor, but I'm really most passionate about early stage. And I'm like, I'm not here to tell you you're not going to succeed, but it's just hard for me to evaluate that fund if there aren't like at least a handful of investments that are like on thesis and within the stage focus. Big jumps in fund size can be tough. Like, hey, we raised a $10 million fund one, we're doing a $75 million fund two. It's like, these are very different fund sizes and different things need to go well in a $75 million fund. There's just like so much less margin for error. I sometimes struggle when folks like can't really explain why they're targeting a certain fund size, like why that's the right fund size for them. My hope is that like this is all built around what's unique about them, and that they're focused on generating great returns, especially in these early funds. Like we're typically investing in funds 1 through 3. I mean, we can go beyond that, but as a general matter, it's funds 1 through 3. And so my hope is like we're just laser focused on generating returns to these early funds. Like that is the long-term greedy move, right? Like you get some great early stage funds, then you get some great first few funds. Your first few funds are great, and then you can go be a venture investor for a long time. And so my hope is like this is really about returns. It's not so much about like what's the most I can raise, what's the most I can deploy. So I want to understand like from a returns perspective, like why this fund size. And so I think a lot of this is just like interpersonal. It's just like relationship building. And if someone invests in a venture fund, the relationship they have with the GP is long term. And so you want to have alignment, and you want to have respect and transparency. And sometimes people can be a bit pushy or push statements they're making to the point of like you kind of wonder whether this is like a credibility question here. I think that does sometimes stand out. I think teams that don't have much experience working together can be tough for me to get to conviction. I mean, this is very hard to underwrite. Like, are they going to be able to go through the ups and downs over a really long period of time, to manage through deploying and then, hopefully getting liquidity from this portfolio? And if they can't, like, GP breakups can be challenging. And so if it's more than one GP, I'm looking for folks who have like very significant working experience together. I do get concerned when I have a sense that folks are like chasing trends in terms of sectors. So sometimes you're like, oh, we talked like 2 years ago, this was a crypto fund. Like now it's an AI fund. Like I don't really I get like there's an energy here, but like why you for that sector? Like, did you become an AI expert or uniquely positioned in AI somehow in a way that maybe you used to be for crypto, or like what happened here? And so I guess like that would be a more general statement, which is also a red flag, with people whose strategies kind of don't align with what seems unique about them, or if they like can't, if it isn't clear there is something that's like so unique that should impact fund level returns, or that you could sort of see a path to impacting fund level returns. Sometimes it's just like, no, like we think we're good pickers. And I'm like, unless there's like a long tracker of that, it's hard to get to conviction on that. Even though that may be true. What else? Like big changes in strategy during a prior fund can be tough. Sometimes, or just like major strategy drift in general can be tough. Because then it's hard to get a sense for like what I'll get. Like if we invest in this fund, like is it going to be the fund that we're talking about today? Because like for your LPs in your last fund, like that changed. And then I think like valuations these days are kind of all over the place, even for the same companies. And so how are people thinking about the valuations of their portfolio? Like are they holding companies at valuations from a time period, like let's say 2020 or 2021, that may not reflect today's value and they haven't adjusted down? Like I want to understand that. And I think if it feels like they're inflating the value of the portfolio, like that can be a red flag. Those are the things that come to mind.
I want to touch up on like a couple of things that we briefly talk about. One is like liquidity, one is portfolio construction. What are some questions that you would ask in terms of like liquidity to emerging fund managers? And what are people's like overall strategy that you think are like kind of working?
Oh man, it's so hard. So my answer to that is, I guess how I want to talk about it is I want to get a sense for how people think about liquidity. Like, do you think about it in a more passive way? Like, hey, some people call it like ride or die. Like, I'm going to the end. I'm not taking anything off. I'm not really thinking about taking anything off along the way. I'm waiting for M&A or IPO or company to shut down. Or are people thinking about it and doing things in a more active way? Like, are they thinking about every round as a buy or sell decision? When they think it is a buy or a sell, when in their opinion, like it's a buy or sell, are they doing something about it? Like if it's a buy, are you doing an SPV? Are you following on? Are you doing something to invest more? And not that you necessarily should, and all, it doesn't always make sense, but like, and then same with the other side. Like if you feel like this is sell, are you doing it? Like, should you try to get some secondary? Should you try to sell into this round? Is there anything that you're doing based on the decision that like you're a seller in this round? Those are the things. I mean, at a very high level, that's like where I would start. Then like, what's the next layer? Okay, so like now let's talk about some specific companies. Like this company you've taken no liquidity from. It looks like an amazing outcome. It's like multiple returns on your fund. Like, how are you thinking about liquidity now? In the last, oh, they did a round in 21 at a very high valuation. Like, did you think about liquidity then? How did that play out? Like, what did you do based on how you thought about whether that was a buy or sell for you? And so I want to get a sense for, as a general, at a high level, how they think about it. And then, like, if possible, if their portfolio is mature enough, like how they've handled it in certain situations. But it's hard. I mean, getting liquidity is the name of the game, but there are a lot of people who, in the early days are trying to figure it out. And it is very hard to like sell at exactly the right time. And like, that is not the standard. If someone's like sells at not quite the peak, like that's not the standard for success, because it is so hard to know what that is. And honestly, if someone does that, the most you can probably give someone is partial credit. It's got to be luck. Like there's some luck involved in that. So I think like my approach to this is I want to understand how they think about it, but you have to be like fair in evaluating folks because it's so hard.
I'm taking notes. I wonder in terms of like, what are some answers that you feel like are good in this liquidity sector? Let's say, again, we don't have to talk about names, just overall, what's our strategy? And then how are they thinking about liquidity? Are you looking to hear like, we want an X amount of return, like when a company hitting X threshold, and then we just get out, or like how would you like evaluate the ride or die versus M&A, IPO? I mean, like the other like SPV and following on or something.
Yeah, I mean, I don't know. Like, I don't think there's one way here, and I don't think there are many rules. But if I had to come up with like a few that are kind of close to rules in my mind, it's like I do hope that folks have enough information about a company that they can make a decision about whether they would be a buyer or a seller when a company is raising another round, whether or not they would actually have a chance to buy or sell into that round. And my hope is that, like, I guess one framework that resonates with me is that if you can return your fund by taking off like only 20 to 30% of your position in a company, that is probably worth seriously considering. But I am like very deferential to folks. They are so much closer to these companies than I am. So like, I'm not telling people to sell. I'm not telling people anything. Like, I'm a thought partner, a sounding board. I'm happy to talk about what I've seen, but like, it's a case by case. If I've invested with a fund, like I trust them to manage this. But I would love to be a call. I often am a call on things like that. And then, yeah, like what I've seen, it's funny. I've seen more regrets from people holding too long than selling too early. But there are regrets about both. Like, you sell too early, man, you could be leaving a lot of money on the table. You sell too late though, and you could have this like amazing company that could have generated meaningful fund level returns, and like it sometimes can go to zero. Like, we've seen unicorns go to zero. We've seen public companies turn out to like not generate meaningful DPI because by the time the lockup ends, like people don't sell, they think it's being undervalued, they hold for long, and then like they end up just holding for too long and the value goes down and to a fraction of what it was. And they, even if they could have sold, like the lockup had ended, they kept holding because they thought it was a better company than the market was giving them credit for. I mean, I feel like I see this all the time.
About like portfolio constructions is people I've chatted with, I feel like the portfolio construction looks basically like half of it they're going to deploy into, some companies, and then half of it for follow on. And I wonder, is there any template for portfolio construction that you've seen working well for earlier stage manager? Or like, I think maybe even earlier stage people, they're all doing like just no follow on whatsoever. I wonder, what's your thought on this subject?
Yeah, I mean, so again, like I don't think there's one answer, but I think about this in terms of like different. So reserves is one component of portfolio construction. So I think of it in terms of like how many investments are you going to make, initial investments into companies? How much ownership are you targeting? How much are you reserving? And how will you think about following up? And so, yeah, like in a perfect world, if you have less experience, I'd err towards less investing experience. I'd err towards lower concentrations, like more shots on goal. That may mean less dollars in reserves. That also probably means like lower, usually these are smaller funds, you're just getting started, so it's lower ownership. So if I were just like step back, I'd say like, I feel a lot of comfort when a fund is getting 30 to 35 companies, maybe a little more, but high enough ownership in those relative to fund size that the fund can outperform if they get into some like great companies, and then it can do well with more modest outcomes. And that often doesn't leave much room for reserves. I also think the smaller the fund, like and the lower ownership you're targeting, like the less important reserves are. Big caveat, of course, like again, like there's no one way to do this. Like I've seen reserve, like follow-on checks can return a whole fund. So like I don't mean to say someone should have no reserves or should never have reserves, or having reserves, isn't a good strategy. But yeah, like my general preference is like less reserves is probably better for returns. Just get more ownership up front at lower entry valuations and let it ride. Like you're going to go through maybe one less round of dilution in a small fund if you follow on. Like you're not going to have reserves following multiple rounds in most cases. So maybe one more round you avoid in terms of dilution. And so then the next question that I have about reserves is like, is there a good reason to believe, like for the GP and for me, like they're going to know which are the right companies to follow on into at the time those companies raise their next round or before? So like, I think it's hard. I think most folks, I mean, some people do seem to know early, and you can certainly get a sense early for whether a founding team is making a lot of progress and a company's showing traction. And you can also probably see some teams and companies that are not looking great in the early days, but like the fastest out of the gates, those are not always the best companies. Sometimes the best companies, like, they just take a little more time to get going. And so, I think it's hard to, at least from talking to other folks, my sense is you don't have a great sense for whether a company's going to be like a real company, set aside like can it generate meaningful DPI for a fund, until like 2 years out. Minimum. But like, look, there are millions of examples and plenty of GPs who knew it sooner, followed on sooner. They were right. It's hard because if you think about just like the timing of it, like from a tactical perspective, like your first investment may be raising another round of capital while you're still making initial investments out of the same fund. This is hard to know, like, is that initial investment going to be one of the best few in that fund? Like you haven't even finished making all of your investments. And then from some of those investments, like very new. And so I think most funds that I'm meeting that are like sub 15 or 20 have like limited to no reserves. The funds that are like more significant ownership, maybe leading rounds, they're going to have some reserves, like for obvious reasons, you're going to have some reserves. Some of this is just like to be able to support founders and to protect your brand and to be good to them. Like you need to have a little bit to be supportive. And some founders, it's important to them to know that their funds, that their VCs can like keep supporting them if they need support. But like, I think the question you have to ask as the GP is like, let's say I'm investing on a $10 million fund. Like, is a founder realistically going to look to me to like support them financially in a time of need? Like I have a $10 million, like, they know that. They know I wrote a $250,000 check into their company. Like they're not really relying on me for that, right? So like, I think this takes some, this is all sort of wrapped into like, what's the strategy and what's the edge about, what edge does this fund have? Why are founders picking them? And I think all these things are related. And then, from a concentration standpoint, like when I said, like 30 to 35 companies, feels like a great number to me, but I've invested in much more concentrated funds. Typically those are folks with like a little more investment experience. But yeah, like I'm comfortable with more concentration and I'm comfortable with lower concentration, but you just have to understand like how this group is going to win and whether they're getting enough ownership in the companies that they're investing in to generate great fund level returns.
I'm taking this. I wonder, I have two more questions on that. One is like, so, you mentioned about this in other podcasts, like first three funds is kind of like career defining. Like if you cannot perform in the first like three funds, you probably won't have like a really just like a long track record or like long career in venture in general. Maybe I'm butchering it a little bit, but like I'll let you talk about it. So I wonder, how do you kind of like have a good first three fund?
Oh yeah. So I guess the way I think about it is like, I think about it in the inverse, actually. Like if you want to have a long career in venture, like you need to do well in your first few funds. I don't know that you need to like, they all need to be amazing. Although like the better they do and the more consistently you perform, like the better for your ability to, the better for you as a venture investor in your career. Yeah. So how do I just think like if you're generating great returns, like you can keep raising capital. And if those first few funds, if that like first fund or a second fund don't generate great returns, I mean, just for obvious reasons, it's just harder to keep raising capital because I think ultimately people will say like, it doesn't look like the first few funds are going well. Like what needs to be true now? Like, what do I need to believe to get to conviction on a fund 3 or a fund 4 when the first fund or 2 are not meeting my underwriting? It's hard to get there. Like just sort of for like naturally.
I guess like, how do you have a first 1 or 2 fund that are like killer portfolio?
Yeah, I mean, I think you need to get into this, you need to invest in great companies. And then the hope is you get enough ownership in those companies, you can generate great fund level returns. If you get in great companies, but you don't have enough ownership, there could be an argument there that like, you know how to get in front of the companies, you know how to win. You could have won more maybe. And going forward, like that's your strategy. You're going to get enough ownership in those winners. But yeah, I mean, I don't think you can win in venture without investing in companies that become great companies. And then the question is like the scale of those companies. Like some funds can generate great returns without a unicorn, but that's hard. Some funds are getting such low ownership relative to fund size. Like they might need a decacorn or some amazingly large outcome to generate great returns. But like maybe they're doing that. So like maybe they're getting tiny ownership relative to their fund size. They invest in, 300 companies and they get like, I don't know, 10 winners. And 2 of them are so big that they like actually generate amazing returns, even though they had tiny ownership relative to the fund size. They were just big enough wins. So I think ultimately, like, yeah, if you want to get returns, like you need enough ownership in great companies.
I wonder what are some good benchmark for the first like 1 or 2 funds to be like able to raise like a fund 3? And is that like, let's say if half of company raise the next round, is that going to be a good performance for like first fund? Or like if none of company dies so far, is that a good performance? Like how do you kind of evaluate this?
Yeah, it's such a good question because like it depends on the time that we're talking
Mhm,
about. If you were like, okay, in 10 years,
mhm,
what does a good fund look like?
mhm,
In 2 years, when I'm raising my next fund,
mhm,
like what does a good fund look like?
mhm,
It's too early to have meaningful fund level returns on like a 2 or 3 year old fund. I mean,
mhm,
maybe in 21, your fund would have been marked up, but like turns out most of those markups like weren't so meaningful. And so, or many of them weren't. They still actually could have been indicative of like promising companies,
mhm,
just like, valuations maybe a bit ahead of traction. But yeah, like it depends on what you're asking about. So like, let's say I'm talking to a fund 3, someone who's on fund 3
mhm,
and they have a fund 1 and a fund 2. They're still investing out of fund 2. So like what you would love to see in a fund 1 is like some real breakouts that have attracted capital from great investors at the next stage. Sure, like high graduation rates is great. High graduation rates into like, let's say an A round led by tier 1s, even better. Or like great investors at that stage, even better. Great revenue, like good unit economics. Like some companies have grown a lot and not raised that much money. Like we have exposure to a company in our portfolio that like has under 10 employees and is generating a lot of revenue and very high margins and is very efficient. And they're not getting marked up
mhm,
because they're not raising capital. They don't need to
mhm,
raise capital and they're growing at a really great rate. And so you just want to understand like how's the portfolio evolving and does it look like there are some winners or promising companies in that fund 1. Fund 2, it's so much earlier. So sometimes the fund 2, you're targeting more ownership and you want to understand like, hey, you get lower ownership in fund 1 companies. Like, are you getting adversely selected? Is there a way to suss out whether you're getting adversely selected when you're targeting more ownership in fund 2? Do you have any companies that are potentially breaking out? Are there later stage investors who are getting excited about these companies? It's similar questions. The challenge is that like at the time you're raising, it's hard to know how like the fund you're investing out of it's too early. So you're still really thinking, I mean, from my perspective, at least, I guess I'm thinking about like mostly qualitative criteria in these first few funds. But if you're on a fund 3 or fund 4, like you should see some progress in like
mhm.
a fund 1, maybe a fund 2.
I wonder if they perform really badly in Fund 1 and Fund 2, would you still looking at it if they have shown some sort of a, like, learning trajectory? Like, they can tell you
It's
from these
harder.
2
I
things
know it's
don't work.
harder. No, it's a good question. I mean, actually, I think about that question a little differently. What's harder? What's harder for an LP to get to conviction on? Someone who's like promising, like a GP who's promising starting fund 1 but has a very limited track record, or like someone who's on like a fund 3 or 4 who has like a track record that's not tracking towards, let's say, meeting the LP's underwriting. You can actually, I think, make a pretty good argument that it's easier to raise when you have less of a track record because there's a potential for a great track record. And even though you have a lot less information,
Mhm,
LPs may take a chance on that. Whereas if it's starting to look like the track record isn't great, I think it's harder for many folks. I mean, I can't speak for everyone, but I think it can be harder to raise when you have a fund that is not showing much promise. But like there are a lot of ways to think about this, and I don't want to be narrow-minded. Like it's my job to be open-minded about this. So it's like, let's say there's a fund that's like slow out of the gates, but like in that sector, it may make sense for the fund to be slower. Like maybe these companies are slower to get going, they're capital consumptive, or there's a lot of building, or a lot is happening before going to market. And like for one reason or another, like it makes sense for a fund to be slower out of the gates, or great companies anyway, the point is that like you can't, I try very hard not to over index on early track records. I mean, at a certain point, the track record is what it is. But in the early days, when it's like your past fund or two funds, like I try to be careful not to read too much into just the numbers or like the markups. But you do want to see progress in some ways. And yeah, it does get hard if you're not seeing that to like invest in a fund 3 or a fund 4.
When you're thinking about like sector and stage people investing in, like, so if they say like let's say a first fund and they're targeting, let's say like a 10 million or something, and then they are investing in 35 company, and they are trying to be sector and stage agnostic. They have unique like entry point into a certain interesting companies because it's fund one. People probably want to logo shopping a little bit. They want to get into a famous company. What's your thought on those kind of strategy? And in terms of sector, it's like kind of all over the place.
Yeah, I mean, I understand there are reasons to do that. It's like be
Mhm.
associated with great companies, and
Mhm.
especially if you're like working with the founder or the management team and like helping them, and like that could impact your ability
Mhm.
to get to source and win great deals. Like maybe like the founder of some great company is like sending you great deals, and they're like going to bat for you and trying to convince founders for like that's valuable. I totally
Mhm.
get that. I think what I'm most interested in, like as an LP, is like folks who generate returns on their funds.
Mhm.
And so I think where I could struggle with that is if they don't think like that can meaningfully impact fund level returns. And my hope is that that a GP believes that every investment or most investments they make have the potential to meaningfully impact fund level returns. And if they can't, and they know that in advance, yeah, it like doesn't feel ideal to me from a returns perspective on that fund, even though it could be a great long-term investment for them, like for the health of their firm. And so my hope is that if I invest, the dollars are going into companies that they think can generate fund level returns for that investment from like every investment they make. But I understand why some people do it. And I would just, in a perfect world, like I'd like to know that up front if that's part of the strategy, and to get a sense for like how much capital do you plan to use that way, and how many shots on goal will be meaningful here. Like, am I comfortable with that amount of shots on goal? My hope is that like I'm not surprised by that. Like, oh, I
Mhm.
thought this was a seed stage fund, and now we're investing in like pre-IPOs or something. Like, we should have talked about that at the
Mhm.
beginning. And yeah, I mean, as a general matter, like I'm focused on pre-seed and seed funds, so like most of them are not doing that, or they're not multi-stage firms as a general matter. So part of the phrasing of the question was like about multi-stage firms, and I think if someone said they were a multi-stage firm up front, like they wouldn't be a fit for Slipstream in any case.
I wonder when you were thinking about, let's say if an emerging manager, they're trying to build their expertise in one specific area, what do you suggest them to go after? Would it be AI or like how are you seeing these like just like hype cycles and like trend investors?
Yeah, I mean, my hope would be that if you have a venture fund, it's because you already have an expertise. Like that's part of your advantage.
Yeah.
So, but look, we're all growing and learning while we're investing, and
Mhm.
so I don't mean to suggest that people shouldn't be doing that. And if they're excited about an opportunity sector, like they should learn about it. And especially when it comes to generalists, like generalists are constantly learning new sectors and thinking about what makes sense for them to pursue in terms of sector focus.
Do you have a preference? Let's say I'm sure you just mentioned you don't like the people who are like crypto today, AI tomorrow. If currently you are planning on starting your own fund in the next 2 years, and what would you be building some sort of subject expertise on as LP when you're seeing these trends all day? How would you pick a trend that suits you? And the other part is like when you're looking at like the GPs, typically people will have some sort of hype cycle portfolio companies. Overall, what's your thought on like how should people approaching these like bigger trends or bigger waves?
Yeah, I mean, I don't know that I have a great answer on the first, like how to pick the right sectors, because like, I guess the question is like, was it better to be an AI investor will we reflect, let's say in 10 years, will we
Mm,
reflect on 2024 as like the best time to be an AI investor? Or was it actually like 2018 or like
mm,
2015? Like
mm,
I think it's hard when it's the hottest sector, like it's hard to compete. There are a lot of investors, there's a lot of capital going into those companies at high valuations, you're getting low ownership. And there are a lot of other things, like in any given sector, that could make it hard
mhm,
for a new like an entrant to invest in the sector. So and I think like a great generalist is constantly thinking about where's the opportunity now? What are the
mm,
founders talking about? What are the founders excited about? What am I learning, reading, talking to whomever is in my
mhm,
network, who I trust? So I'm not sure I know the answer to that. Like, how do you find new trends? I think like, or how do you figure out what sectors to focus on if you're a generalist?
mm,
I think you're talking to founders. I think you're talking because founders are kind of on the forefront of innovation, and so like you want to know what they're thinking, and you want to be
mhm,
flexible enough to do things that seem unusual and not hot
mhm,
and like not conformist, because often like I mean they're the real innovators. But I think there are like other academic ways to go about it, and certainly there are some like there are plenty of like thesis focused investors who are thematic. They do a lot of research. It feels very academic, and they pursue themes that they believe in. And there's not a wrong way to do it, but I think chasing the trends is tough. And I think if you were going to do it, yeah, you'd want to believe that like you're going to be able to source and win allocations in the most promising companies, and that's it. It's just really hard to do it when it's the trend, and if you don't like have some deep pre-existing expertise already.
for sure. What's your when as an LP, how do you become an LP and like how do you do your portfolio construction? And if a emerging manager is trying to build a relationship with you, which I think everybody who is listening to this are probably trying to build a relationship with you, how do you suggest them to do so?
Yeah, that's a great question. So I guess in reverse order. So how to build a relationship? Yeah, like I think, just like a GP builds a relationship with a founder, like coming from someone who is like in my network can help just like move it forward faster. And I don't think there's any wrong way. I think the right way to do it is just like genuinely like with transparency, like being open. Like sometimes people like want to create urgency when there isn't, like create some sort of false sense of urgency, or they could be a
Mhm,
little pushy. And it's like I think that can be challenging for me. Also, like I'm a solo GP myself, and so like sometimes I have to go deep on something, and like I can take a little time to get back to folks who are earlier in the pipeline. And I try to be candid with people. Like I try to be open with people. Like, hey, I need a little time here. And if we don't have time, like then I will move fast. Like we're not going to miss opportunities because of that. But like some, grace when it's like a busy time. I don't. But I think it's personal, and I hope it's like real and open and not all sales, like not all transactional. The on my portfolio construction, yeah, I mean, it's a great question. So we get 3 to 5 years of vintage year diversification. We have geographic diversification. We have diversification across, 400 to 600 companies roughly in a range of sectors. Most of the capital in a given Slipstream fund goes to about 12 to 15, what I call core investments. So yeah, those can range from 6 or 7% of the fund to about 12% of the fund. And the hope is that like we're very high conviction. That's pretty concentrated strategy, and we want, yeah, if we're making the right investments, like we want to be able to outperform. I want this fund to be able to generate like alpha. And I think if I'm too diversified, it's hard to do that. And so it's a relatively concentrated portfolio of 10 to 15 funds, mostly 10 to 15 funds, but it's diversified across many vintages, geographies, companies, sectors. And the third question you asked, how to become an LP. Yeah, I mean, I think I took unique path to that. Like this was never my career goal. Like I didn't set out, I didn't like graduate college and like I want to be an LP. I think the question is like, I think you could be a venture LP if you learn venture and you understand venture and you have a good sense for how rounds come together and why certain funds have been successful and what kind of edges and advantages that funds have can resonate with founders. Why do founders pick certain funds, and what do those working relationships look like, and how have funds historically been able to build flywheels in their communities of founders such that like they are making good investments, and then they're seeing great founders and they're making more investments because those great founders want to work with them. And I think if you've seen it in action, I think you can become a great LP or become an LP. I think becoming an LP just like requires, I think a pretty deep expertise of venture or deep understanding of venture.
What does LP's career journey look like in general? And then like, who do you socialize with, since you're also a solo GP? In terms of raising fund, are you also constantly raising fund for yourself, or how does it work?
These are great questions. Career path of an LP, like I guess I should only speak for myself. Like my hope is that I can do this for the rest of my career. I love doing this. It's a lot of fun for me. And it's very long term. Like any fund that we invest takes a long time to wrap up. And so it's a long-term commitment. If you're going to be an LP, like you make one investment, it's a pretty long-term commitment. Yeah, socializing. I mean, I love collaborating with LPs of all types. It's helpful to hear how other people are thinking about the space and what they're seeing and where they think venture is going. It's constantly changing. And like the question, it's funny, like some folks like have an amazing track record, let's say like 10, 15 years old. It's like venture's different now. And venture's going to be in 10 years when we're making investments then, like it's going to be different than what it was, today, 10 years prior to that future point. And so like I'm constantly thinking about like, where is this going? And I love hearing what people think and who's uniquely positioned to win now and who's going to be uniquely positioned to win in 10 years. Like collaboration is fun and helpful for me. And like also I've just like developed a great community of folks who I view as mentors, over many years, like going back to QED and even before in venture, who've been very helpful to me. And then, my fundraising cadence. So we're typically deploying funds on like a 2 to 3 year basis. And my hope is, you're kind of always fundraising to some extent. Like you're always building relationships with folks who may be investors in your next fund. And those are important relationships to me. I constantly want to meet new folks. And like I have plenty of those now where it's like, hey, we catch up quarterly. We do something in person, or they come to the annual meeting or something like that. Those are really important to me to keep fostering those. But like there's a difference between fundraising while you're open and fundraising while you're not open. And the hope is that like you're fundraising while you're not open, you're building those relationships. And when you're open, fingers crossed, folks are sort of have more of a prepared mind on the opportunity. And hopefully you're not open for that long, even though it's a very hard fundraising market now. So you wouldn't want to be presumptuous about that. But the hope is, you're kind of always fundraising. And then when you're actually open like that, because you're always fundraising, the time when it's open is shorter.
So we're at the last part of our interview. I have like a 1-minute fire round for you. Number one question is, what's your favorite book?
Oh man, favorite book? Probably Meaning of Life by Viktor Frankl.
The Meaning of Life. Okay, so who would you invite to your dinner party?
I don't know. I had no time to prepare for this. I don't know. Maybe Michael Jordan. I just think probably Michael Jordan.
Okay. Who made the biggest impact in your career?
I'd have to say Nigel at QED. This does not happen without him at QED. No way.
Where can we find you outside of work?
Riding my road bike.
Amazing. Okay. Thank you so much, Alex, for coming on the show today.
Thanks for having me.
Thanks for tuning into Smart Venture Podcast. If you learned something from the episode or even just mildly tolerated me, please subscribe and leave a 5-star rating. I promise I will keep bringing you more successful, insightful interviews and insider tips about startups. Remember, sharing is caring. So tell your friends to listen too, or enemies, I won't judge. Until next time, keep venturing smartly.